Welcome to Mogobe Nuggets of Wisdom podcast. My name is Mompoloki Lerumo. Our objective is to enthuse, inspire, energize, and empower entrepreneurs and entrepreneurs of all stripes here in BW and beyond. We do so by inviting these entrepreneurs into our makeshift studio. Sometimes we call them to the restaurant, sometimes we go to our studio, and we ask them to share their experiential knowledge, their experiences and their expertise. And we ask them as many questions as we can, aimed at empowering you also as a viewer. Hello dear viewer, dear listener. My name is Mompoloki Lerumo. Welcome to a bright new year, which is also a bright, wonderful decade. My first guest is Zachariah George, who is a venture capitalist. If you don't know what a venture capitalist is, you'll get to find out today. But as usual, I prefer that my guests be the ones who introduce themselves. So over to you, Mr. George. But I think I prefer Zach. Do you mind if I call you Zach?
Absolutely, Zach's
okay.
A lot better.
But for those who don't know, sometimes we call him Brown Jesus because of the way he looks. Welcome to the studio.
Thank you very much, Mr. Mogobe.
Would you care to share with the viewers your background a little bit?
Sure.
Yeah.
So I grew up in the Middle East, and I'm an engineer by degree, a mechanical engineer from the Indian Institute of Technology. I then got my master's in finance from Stanford in California, which was when the first sort of understanding of Silicon Valley and the importance of technology changing the way we look at businesses across the spectrum first inspired me. Stanford's a fantastic school, as everyone knows. I then went and spent almost 7 years on Wall Street as an investment banker. So I was a banker at Lehman Brothers for many years until they crashed. And then later on was an assistant vice president at Barclays Capital doing mergers and acquisitions. And then in 2010, I took a bit of a sabbatical to come to South Africa. On paper to watch the World Cup, but I was also just intellectually curious about the gap between the capitalistic world of Wall Street and the social philanthropy-driven NGO world, where Africa was a big part of it. And I was intellectually curious about bridging the gap between these two worlds. So how can we create more impact-driven entrepreneurship on the continent of Africa, but with a mindset of Silicon Valley from an innovation standpoint and the profit motivation of Wall Street. So I came to South Africa in 2010, not expecting to live on the continent of Africa, but I saw a lot of similarities between Silicon Valley and, at the time, Cape Town in South Africa. So I started investing a bit of my money as an angel investor into several African early stage technology startups like Flutterwave in Ghana, Mpost in Kenya, Recomed, HouseMe, some really pioneering companies. And then I said, I cannot scale this doing it myself. And what's really important is you need to create a culture of innovation and a culture of wealth creation, not just wealth preservation, which is a big sort of deterrent in Africa. So I then, over the course of the next 3 or 4 years, set up the largest accelerator in Africa, which is an accelerator is essentially an organization that takes high-profile, highly innovative and high-growth tech companies, takes them from an idea to a minimal viable product to a sustainable growing business based on exponential scaling. Which is what happens a lot in Silicon Valley. So I built the first accelerator in Africa that I can talk about later. And on the back of that, we've had more than 50 investments, 50 investments into tech startups in Africa, personally and through the accelerator. And I've now launched the largest seed fund in Africa.
We'll talk about that in a bit. But I'm just curious, you mentioned the angel investing.
Yeah.
And I introduced you as a venture capitalist.
Yes.
There might be someone curious out there. What is the difference? Why do you call yourself a venture capitalist? Why does somebody like myself call themselves an angel investor?
Yeah.
What are the distinctions?
Yeah, so angel investors invest very early. They back strong founders. Angel investors typically come in before the first institutional round of funding comes into a company. So It's usually friends and family and angel investors are giving you some amount of money, but it's opening up your networks and opening up your understanding of an industry's knowledge. So if you're, a career banker for, let's say, 10 years, you probably have a better understanding of fintech companies or insurtech companies. If you spend most of your life in retail, you could help e-commerce companies. So angels add a lot of value at the early stages of a company. A lot of the angel investors in Africa back companies that are pre-revenue or maybe slightly post-revenue. A venture capital fund is one notch after that, which is you have what's called general partners that manage pools of capital, either from individuals, family offices, or institutions, and they have to deliver a predetermined minimum rate of return, which is called your fund IRR. And that tends to be more mature capital going into businesses that have already gotten seed funding from angels. So angel investing, very simply stated, is early stage funding for companies that cannot access institutional capital. A VC fund is high growth, high risk capital coming post angel funding. So you've got the founder's own capital, friends and family, angel investors, and then venture capital.
Makes perfect sense.
Yeah.
All right. I know that the area you are operating is the area of innovation, and there's an element of disruption. Let me ask you this question in the context of Africa. Is Africa ready for disruption? Two-part question. Is it ready, and why?
Yeah, I think, first of all, it's ready. It's taken a while. I would say before 2010, I would say Africa would be very far away from being ready for disruption. We didn't have any e-commerce companies, any food delivery businesses, any online booking platforms. Technology disruption was pretty much non-existent before 2010. So most founders in Africa have tended to work or to be like SMEs, small businesses. So the difference between a startup and an SME is a small business's only focus is profitability and a lifestyle for the entrepreneur. So you create a lot of wealth, but it's not exponential. You can never go from 100 customers to 100,000 customers in 3 months. That's what a startup does, right? So it took a while for African founders to understand how to scale their businesses exponentially. And that can only happen when you are tech enabled. So you use things like artificial intelligence, chatbots, machine learning, sensors, drones, the gig economy, which is sharing on multi-user platforms. That's how you can scale very quickly. And that's what Silicon Valley did so well. So the example I give is often, I can start a taxi company and employ drivers, but I'm limited by the number of drivers I have or the number of taxis that I have. And every additional taxi requires capital. That's a small business. A startup, on the other hand, uses exponential scaling where you build the software and the platform where you allow multiple users, fleet drivers, inspectors, drivers, customers to all plug in, and you're the platform. And you make money through software as a service, subscriptions, licenses, commissions, transaction fees. That's the difference between an SME and a startup. And startups can attract venture capital and angel investments because it's high growth and high scale. SMEs typically access working capital, bank financing, etc. Nothing wrong with the two, it's just they're different. And as a founder, you have to know which bucket you're in.
Distinction.
So Africa is ready. The last 5 years, we've seen several technology startups in Africa that have understood how to scale like their counterparts in the US and Europe and Asia. The total amount of venture capital funding on the continent of Africa has grown from as little as $20 million back in 2010, 2011 to over $2 billion in 2019. So there's been a very quick growth in VC funding, and it's getting better by the day. 2020 had a slight dip because of COVID all across the world. But as far as I'm aware, the numbers were not too far away from the 2019.
This might be a bit of an unfair question. You've talked about Africa as a whole. Can we narrow it down to Botswana? I say it might be unfair because you've only been here for a short time.
Yeah.
But what are your preliminary impressions? Is Botswana ready for angel investment, for venture capital investment, and what are the indicators?
Yeah, that's a fair question. So obviously the largest markets for technology innovation in Africa tend to be South Africa, Nigeria, Kenya, and Egypt as the top tier. It's also to a large extent driven by the size of the market, or the total addressable market. So what's interesting is because Botswana's population is only 2 million or 2.2 million, 2.3 million people, you can't build a sustainable, scalable, and exponentially scaling business if you only have 2.2 million customers, right? And of that, it's only about 500,000 that are active, from an economically active perspective. But what does work, is B2B, which is, can you work with banks, with retailers, with insurers, with telcos? Because then the constraints on the size of your customers does not exist anymore. So what's important, so Botswana definitely has a culture of innovation. Entrepreneurial founders that I've met, even though this is my first time in Botswana, I've done a lot of work through the Botswana Innovation Hub, through the Enterprise Development Program, to some of the large corporates here. I think there's a culture of innovation. What you have to understand very quickly is, even if you are serving large businesses, B2B clients, you have to think outside of Botswana very early on. So if you look at, for example, Nigerian technology companies, they focus on cornering a market in Lagos or in Abuja or their major hubs, but very quickly by year 2 or year 3, they're out of Nigeria. And you don't have to reinvent the wheel and open an office in Kenya or in South Africa or in Ghana early on. You can always do it through license agreements. So collaboration and partnerships is super important when you scale. If you use other people's networks and resources and incentivize them, you can grow very quickly. So what I want to see is, Botswana's got lots of talent. You need to be able to scale outside of Botswana very quickly and have a Pan-African presence. And that makes you more attractive to angels as well as VCs.
I want us to dig a little deeper. Thank you for that wonderful answer. I want us to dig a little deeper in terms of the 5 key components of a successful startup ecosystem. And I want us to drill in and deal with them one by one. You have actually narrowed them down for me. You've made my job a lot easier. What would you say when we talk about team, which is one of the key core components? Why is that important? And can you just help the viewer understand why this is an important component?
No, I'll give you 2 perspectives. So I'll talk about the ecosystem later, about 5 components that make up a successful ecosystem. I think for now I'll focus on 5 to 7 of the top metrics that VCs, venture capitalists, and angels, but mostly VCs, look at when they invest in companies. So, team is super important. When you invest in early stage companies, there isn't much of a track record from a profits, EBITDA, or revenue perspective. You back founders. So you look at founders that have a prior track record of creating revenue, ROI, and returns for their investors, and for more importantly, founders that really have a good understanding of their market, the purchasing power of their customers, how big the market is, and how they capture market share quickly. You also look for founders that are, I love this term, they are assertive but not arrogant, right? So you need to back a founder that's mentorable and coachable, and not someone that thinks that he or she can do everything himself. So you need founders that A, get the market really well, understand the concept of scaling quickly, and are coachable and mentorable, and not founders that are extremely
full of
themselves. And someone that can build a strong team around them In fact, the goal of a strong founder is to make himself or herself dispensable, not indispensable. So can the company run beyond you? So if you look at the initial days of Apple, people invested in Apple because of Steve Jobs. And then Steve Jobs died, but Apple still carries on.
Still running, in fact, even
right?
better than when you were
Even better, possibly. So the question in Africa is, how many African businesses, even that are not tech, collapse after the founder goes? Many of them collapse. So the key thing
great
is,
majority of them.
yeah. So you need to back founders that are humble, but at the same time assertive and can inspire their team to build. So that team is very important.
Yeah. Can I just, park there for a little bit and say, in the 10 years you've been in this space, are you able to give examples of specific industries or specific founders, maybe not necessarily mentioning names, unless you have their permission to do so.
No, for sure.
Where the team aspect proved very important, and in terms of the character, especially of the founder or the entrepreneur himself, the main guy who started it all.
Yeah, no, of course. I've got plenty of examples. I mean, I'll give you an example of one of the biggest success stories of Startup Bootcamp, the accelerator that I started, and sort of my involvement in the company. It's one of the largest digital banks in Nigeria. And the founder came to us about 2.5 years ago to join our accelerator. He was a very humble guy, but knew his market really well. He had a microfinance license. And his knowledge and understanding of digital banking, customers, how you can have multiple lines of revenue, and understanding how to onboard customers from a digital banking perspective and how to scale exponentially was brilliant. So he was coachable, he was mentorable, and he inspired his team. This particular bank, digital bank in Nigeria, has now grown to more than 400,000 users in just 1 year. Right? It's in Nigeria.
From 0 to 400,000.
Yeah, in 1 year. And they process almost $1 billion in transaction volume every month. So that's a founder that is extremely confident, knows his industry well, knows his customers. He's now raised a pre-seed, a seed, and Series A round of funding. He listens to his investors. He listens to his banking partners. He knows that he can't scale as a fintech without partnering with other banks in Nigeria and eventually the rest of the continent. So it's understanding that you need to be able to have good relationships with your partners, which are large corporates, with your customers, which are individuals, and with your investors that fund you. So understanding all three and scaling accordingly is super important. So that's something that's very important.
Yeah, let's deal with TAM, Total Addressable Market. Define TAM, first of all, and then help the viewer understand why that is a crucial component.
Yeah, I mean, ultimately, if you don't have a market for your product or service, no matter how good your product is, you're toast, right? So a problem that a lot of entrepreneurs make is they focus on trying to sell whatever they have, their product or their service, without understanding customer needs first. So I always tell entrepreneurs, if you don't back a founding team that understands a product market fit and a problem solution fit, it doesn't matter how good your technology is or how good your product is. So you always have to reverse engineer and start with your customers first. What problem are you solving for them? Why is it such a big problem? And how are you providing a solution? I call it's in the industry, it's called the bleeding neck problem. So bleeding neck problem. So if you have something that is affecting you so much that you will accept any solution that solves that problem, then you'll buy it. I mean, there are lots of analogies.
Without worrying about price.
Without worrying about price.
Yeah.
In fact, I'll come to it later. So there are startups that provide oxygen. There are some startups that provide an aspirin or Dispirin. And there are some startups that literally are like jewelry. The difference is a startup that provides oxygen lets you survive. So it's something that is such a big problem that I will do whatever I can to use your product. Other startups will solve a temporary problem. If you have a headache, you want an aspirin. So a startup will solve a particular need, but it's very temporary. And then there are startups that, in fact, most startups are like jewelry. They'll give you something that's nice to have. It's not even a need, it's cosmetic.
Yes.
Most startups offer solutions like that. And the really good startups are startups that can take something that for now is a nice to have and they make it a must have. A good example of that is if you look at Apple and the iPod. You know, it wasn't a requirement to have 1,000 songs on your phone back in 2005 or 2006. But they created a virality around it that it's now a must have. It's a similar thing with Booking.com or Airbnb, where people were very happy to book through travel agents and Flight Center and get all the and pay them for it.
Yes.
Now you can do it entirely yourself, the click of a button, and it becomes a must-have, right? So that's how you look at your addressable market. Your addressable market is how many. So TAM stands for total addressable market. Is how many people will be in the long-term users of what your product is. And within that subset, how many can use your product now? And what percentage of that market can I monetize right away?
What does that require to develop that in an entrepreneur? Does it require specialized training? Does it require, is that what your incubation system does? I'm just curious as to how we get entrepreneurs to that level.
I think a lot of it is the ability to coach an entrepreneur to think global from very early on. So you've got to get a product or service into the market that can scale outside of your immediate local market early on. So you've got to encourage founders from the day they start a business to say, how can this business work in a neighboring country, Pan-Africa, North, South, East, West, early on. And then you come into a different aspect is, if you want to attack bigger markets, you also have to understand things like your IP. What's the best jurisdiction to house your intellectual property? Is the current country that you work in restrictive from a transfer of technology IP? Most prominent African technology startups tend to set up their holding companies in Delaware, in the US, or in the UK, or in Mauritius, or in Singapore. Not because they want to move their operations there. The operations are always in the local country, but from a tax, IP, regulatory, and comfort of investment perspective, it is easier for international investors to invest into a US or Mauritian or Singapore entity, and that entity owns 100% or the vast majority of the local operations. So you create jobs locally, for example, in Botswana, you pay taxes locally, but a US Delaware holding company owns 100% of the Botswana entity. So all the investment comes in at the holding company, all the jobs are created locally, and you're able to scale a lot quicker because you're in an IP-friendly jurisdiction. So that's another aspect of the total addressable market that is that's in place.
Yeah. Let's talk about traction, because that's another component.
Yeah.
Sometimes we assume that people know what we mean when we say traction, but they may not necessarily know.
Yeah.
Tell us what it means exactly and break it down and help us understand why it is so crucial.
No, traction is very important. In fact, of all the metrics, I would say traction is probably the single most important metric. The reason for that is there's nothing that demonstrates the proof of your concept and the proof of your business more than a customer or a user that's willing to pay you for your product or service. Now,
so it's basically proof of concept.
Proof of concept. Now, traction can come in multiple ways in different industries. So in certain industries, traction is, I have more users. In other industries, it could be in fintech, it could be if you're a payment processor, the traction is the amount of transaction volume that gets processed. In other industries, it could be revenue. So the key thing to understand is you really have to understand what are the metrics in an industry to know what metrics make sense for what industry. So for example, if you're a payment processor or a digital bank, as an example, no one cares about profitability. What they care is how much transaction volume are you processing, your gross monthly volume. It could be payments, it could be lending, it could be peer-to-peer, it could be bill payments, but what is the total amount of volume that gets processed every month through your platform? That's a very important indicator. But in other companies, like for example, in an insurtech, what you're looking at is what is your gross monthly premium collected? What are your loss ratios? Those metrics are more important. So it's very important as investors to have a good understanding of what metrics are important for what industry. But generally speaking, revenue is a good indicator of traction. And all else being equal, if you're looking to raise an institutional round of funding, which is usually called your Series A round, which is your first institutional check, firms globally, investment firms are looking for startups that are doing at a bare minimum of $50,000 in monthly recurring revenue, but likely closer to $100,000 in monthly recurring revenue. The key word is recurring, not once off. And how do you generate recurring revenue? Through license agreements, subscription agreements, software as a service, where you charge for the use of your software or your platform. That recurring revenue is super important.
Yeah.
You know, why do you think Spotify makes so much money? It's because yes, they pay a lot of money to their artists for licensing their songs, but every subscriber of Spotify pays them $5, $6, $7, $10 a month. And that recurring revenue gives a baseline. It's software, and it's a license. So that.
So you really want that repetitive income.
Yes, not once-offs.
Yeah.
Which is what differentiates a tech-enabled startup from a non-tech startup.
You mentioned in passing, insurance business, and I happen to know that you have some connection with Alpha Direct, which is a local insurance business. Giving that as an example, because we're familiar with Alpha Direct in terms of their business model, how does it fit into what we're talking about in terms of traction, in terms of some of the metrics we mentioned? Yeah,
I mean, I'll just fast forward to some of the metrics. So a team, total addressable market, the traction, technology.
Technology is actually the next one.
Yeah, technology is super important, where you want to hold something, you want to have either a patent or an IP or something that makes it difficult for competitors to just copy what you're doing.
It's like a moat.
It's like a moat, exactly. And then the last two metrics that we look at is your, do you have the potential to transform an industry, so transformation. So can you use technology to transform an industry that is typically not disruptible? So for many years, the real estate industry had no tech. It was all property brokers trying to get more clients. But now you have an abundance of prop tech companies that are using technology to do virtual reality, viewings, online payment of rental income, where landlords can have auction processes for tenants to book properties. Airbnb is a great example of innovation in property tech. So the ability to use technology to transform industries. And the last two things, I'll get to Alpha Direct in a second, is timing. So how do you create something in a market from a timing perspective when no one expects you to come in? So the most successful tech ventures in the world were not necessarily the first ones in the market. So Google was not the world's first search engine. There was Ask Jeeves, there was Lycos, there was even Yahoo briefly before Google took over. But they got in at the right time because there was the right interest from the market for a solution. Similar thing with Skype. Skype was not the world's first voice over internet platform protocol.
Apparently they benefited a lot from COVID.
That much at a Zoom much later, exactly. So timing is super important. And then the ability to deliver at least a 10 times return for investors. So Alpha Direct is a good example of a Botswana company that has a great team, a founder that's very ambitious, aggressive, but at the same time very
innovative, yeah.
coachable, very innovative. They, although their initial market is Botswana, they have a very strong channel to retailers through Choppies and other platforms. So they're using the distribution and scaling of a large retailer to get more customers. So the total addressable market, even though Botswana has a small population, the retail B2B channel makes it big. And they have ambitions to expand into South Africa and Zambia very quickly this year itself. The technology is patented, insurance in a box. They have a lot of traction. I can't disclose numbers, but it's they're for a company that's about 3 or 4 years old, they're doing several dozens of millions of pula in revenue. So that's very attractive to a venture capitalist. And they scale exponentially. They don't grow from 1,000 customers to 1,100 customers in 2 months. They go from 1,000 to 2,000.
We're really talking about that hockey stick.
The hockey stick curve.
Yeah.
Those are some of the main metrics we look at when we look at investing in companies.
Okay.
And I'm happy to talk about some of the underlying metrics you look at in an ecosystem and what
like
makes
transformative is one such.
Yeah. I mean, so if you look at, so everyone knows Silicon Valley.
Yes.
Right. Silicon Valley is the mecca or the holy grail of startups. So the first component is Silicon Valley has great entrepreneurs. So you need to look at, if you look at Gaborone, you look at Lagos or Cape Town or Nairobi, you need to have a strong network of entrepreneurs that are tech savvy, that understand tech, design, development, marketing. You need to have strong entrepreneurs that typically come out of universities and choose not to go work for big corporates or go to academia, but rather go and work for startups. So that culture of entrepreneurship needs to come in very early. And that's a common trend you see in Silicon Valley, you see it in Bangalore, you see it in Tel Aviv, you see it in Beijing, you see it in Berlin. So we need to see that culture of tech after university going into startups. And in Africa, you see Nairobi, Lagos, and Cape Town as 3 big hubs for innovation. In Gaborone, I'm hoping that you will find more graduates from universities here choosing to go work for companies like Alpha Direct, a startup, than to go work for a Pick and Pay or a Masscom or a big corporate.
Yeah, or
right?
government.
Or government. That's an important thing. The second thing is the kind of capital that comes in. This is why I'm very happy to see that the ANB, the Angel Network Botswana, is active. It's not about how much capital you have, it's about how much risk capital you have. So there's no point having billions of pula or dollars in capital, but all the capital goes to investing in real estate or the stock market or in
help the listener, including myself, understand that. Why is risk capital more important than, if you like, regular capital?
Yeah, because if you have a lot of capital, but you only invest in low risk assets, like the stock market or pension funds or mutual funds or real estate, you're not creating wealth. You're just redistributing wealth, right? Which is what happens all over Africa. You're recirculating wealth. Whereas if you take, let's say you're, a family office or individual in Botswana, and you, let's say, have a net worth of $2 million, and you take $100,000, which is 5% of your net worth, and invest it into an Alpha Direct, an insurtech, or an e-commerce platform like Jumia, or a financial technology company like DPO or Paygate. You're investing in innovation, and these entrepreneurs will become the future market leaders in banking, in insurance, in telecommunications, in marketing, advertising. They're now creating jobs, creating wealth. You're investing money into innovative businesses that will challenge all the regular incumbents. Those returns are exponential. So you can take your money, invest it in the stock market, or invest it in real estate. If you're lucky, in 5 years, you can maybe double your money or triple your money. But if you invest in innovative technology startups, yes, some of them could fail. But if you do it through a structured way with the top tech startups through an accelerator or a fund, you can sometimes make as much as 100 times your money in 3 to 5 years. In fact, we have a digital bank in Nigeria where we've made a 600 times increase in our money because it's technology. Right? So I think it's exponential, right? So the guys who invested in Airbnb, Uber, Twitter, Alibaba, Facebook have made 1,000 to 5,000 to 10,000 times their money. So the key thing is, how do I identify these companies? How do I screen them? How do I know the good ones from the not so good ones? And the return. So that's why it's your attitude to money. Risk capital is often more important than just having capital. And in the US, in Europe, and Asia, there's more risk capital than just capital.
No, you've answered me very well.
Super, super important.
Here's the challenge for a place like Botswana: achieving the necessary buy-in, or if you like, the paradigm shift, educating not just the market, but the other role players like government. How do we go about doing it, and how have you done it in South Africa? Because I think there, the environment is more welcoming, if you like.
Yeah, I mean, and that brings me to the next point, which is the importance of accelerators and incubators. So you need to educate the market. And it starts from finding good entrepreneurs, but you also need to involve large corporates. So you need to talk to the big insurance companies, the banks, the telcos, the retailers to say, why is it important for you to work with startups and not just treat them as recipients of your CSI or your enterprise development, which is essentially free money. So how can you, as a large corporate...
90% of which is unsuccessful,
unsuccessful, because it's a grant. So how do you educate the ecosystem? So I always say, don't build an empire, build an ecosystem. Because the only thing we know about empires is that they eventually collapse. So be collaborative. So you're educating large corporates across Africa, because I live in Africa, to work with startups through a commercial channel, through pilots, proof of concepts, JVs, license agreements. So then you have a startup that is very lean, agile, iterative, innovative, but they lack distribution. And on the other side, the corporate has all the customers, all the distribution, all the sales channels, but they cannot launch new products because it takes too much time, resources, effort, money. So corporate startup collaboration is a marriage made in heaven. So that collaboration is very important. And then how do you achieve that? Through things like accelerators, which I was one of the founders of Startup Bootcamp. So you have a safe space.
So an accelerator is indeed a startup bootcamp.
Yeah, it's like literally a boot camp for startups to say, come in, Mr. Founder or Mrs. Founder, with your idea, your product, your platform, and then we're going to get large corporates all over Africa to help you commercialize that through a revenue share, through a license agreement, through a proof of concept, and eventually we will help you as corporates to help you scale your idea. And on the back of that, you have investors, angels and VCs saying, I will back you as a founder because you already have a proof of concept verified by large corporates. You know your distribution. So it's basically de-risking a startup that just goes on its own without any corporate partnerships or external mentors. So those are some of the key factors that you look for in an ecosystem. And I strongly believe that Gaborone, once they have the right corporate involvement in startups, once they have, and it's very important. So the other point is like, how important is government? Government, you can't ignore government, right? But government's role is to be an enabler and a supporter and not to interfere. So government should do things like provide R&D grants, tax subsidies for founders. In fact, there are startup acts in Tunisia, for example, all the way in North Africa, where if you're an entrepreneur and you're building something innovative, they will give you so many incentives, like a 3-year tax holiday, grants towards building your R&D facilities. They will give you free accommodation in co-working spaces. So government has to incentivize entrepreneurs, but not interfere.
And in terms of what you've actually done in Cape Town, can you give us the numbers to give us an idea of what can possibly be replicated here? I mean, how many initial graduates, and how did the whole process? How did the whole process? Shall I?
No, I mean, he's going to get some.
How does the whole process work in terms of numbers, so that we can better appreciate?
Yeah, I mean, so as an accelerator, Startup Bootcamp is a global accelerator. It's the largest accelerator in the world outside of the US. Globally, we've accelerated 900 plus companies. In Africa, we ran 3 cohorts over 3 years. So we saw about 4,000 startups all across Africa, very good founders. And in partnership with our corporate partners, we had a very long selection process. And over 3 years, we chose 30 companies, so 10 every year. We invested a small amount of money, lots of time, lots of mentorship, lots of technology, legal, consulting advice. We put them through a 13-week program, which is an accelerator. And literally, we take them from like a small company with an idea and maybe a product with some revenue possibly to the end of the accelerator, where they have HR, legal, IP, tax, all of that sorted. They have a product market fit, they have more customers, and we have something called a demo day, which is when they're ready for investment, 13 weeks later, they pitch to investors, but they also have commercial contracts or at least pilots in place. So of the 900 companies globally that we've invested in, more than 2/3 of them have gone to raise future rounds of funding, Series A and beyond. More than 70% of them are successful in the terms that they're still going concerns, they're running, they're operational, whereas the global average is about maybe 10% of companies, in fact, less than 10% of companies, startups, survive beyond 2 years. So of the 30 investments in the Africa cohort, about 80% of them are active, operational, have raised rounds of funding, which is very impressive. And then I've got a further 25 companies as an angel that I've invested in. So our success rate is north of 80%. Like I mentioned, one of the companies we've invested in, a digital bank in Nigeria, we have 600 times our initial investment. The average is about between 5 to 10 times return within 3 to 5 years.
Wonderful, wonderful. So, before I talk about your actual fund, I want us to cover the rules of
unit economics.
Yeah, the rules of startups. The first one is
cost of customer acquisition.
Cost of customer execution. I've got it all set up here. If you allow me a second. Technology is failing me a bit here.
I can talk.
Rule of 3, rule of 40, and rule of 4. That's it.
So
let's start with rule of 3.
Rule of 3. So there's something in the venture capital world which is very important that very few private equity firms or banks or institutional capital understand. It's a very venture capital early stage tech metric, which was started in Silicon Valley. Is I don't care about what your profitability is or what your EBITDA is. What I care about is as a startup that grows exponentially. So if you want to be an Amazon or a Facebook or a Dropbox or a Uber or Airbnb or a Twitter, you have to really understand what are you paying as a company to acquire customers.
Cost of customer
acquisition.
Cost of
customer. It's called CAC, cost of acquiring a customer. Right?
Customer acquisition.
And how does that change over time? So ideally, using technology, you need to be able to lower your cost of customer acquisition, your CAC, with every successive week, month, year, etc. Now, you have to compare that against what's called a customer lifetime value, a CLV, or a lifetime value of a customer, your long-term value of a customer. So let's say I start a business tomorrow, a startup, and I say, I'm starting Airbnb as an example, right? I need to find out, how does Mr. Mogobe travel? Where does he typically stay? Does he like this? Does he like that? I'm going to do a lot of research on you, and eventually I'm going to acquire you as a customer, even if it's just a test. So let's say I take my entire marketing costs, I divide that by the number of customers that I've onboarded, and that is my cost of acquiring each customer. So let's say I've spent $20 to acquire you, Mr. Mogobe, as my customer. Now, I need to know for how long will you be a customer of my enterprise. So how often will you use Airbnb? What are you going to pay on average to me? And what is the lifetime value of you as an Airbnb customer? Similar thing for a Spotify or an Uber or anything for that matter. Now, ideally, if the lifetime value of a customer is at least 3 times the cost of acquiring that customer into perpetuity,
Yes.
that's an investable business, right? Just general high-level metrics. So
the 3, where does the 3 come from?
So for example, if I spent $20 as an example to initially acquire you,
Yes.
right? That's the cost of my marketing, my customer validation, my research, all of that. And I know that over the lifetime of my business, you're going to pay me $60. 60 divided by 20 is 3. I know that I'm getting 3 times the value from you as what I spent to acquire you. And that into perpetuity means that I know that this is your worth to me. And built into that is, initially I sell you one product, but now I know that you're, and this is the next metric, which is
The rule of 40.
the rule of 40, which is your EBITDA, which is EBITDA is basically your net operating profit.
Let's
after your fixed
let's not
costs.
assume that our guests know all this. EBITDA, net operating profit, simplify it for us in the context of the rule of 40.
Yeah. So just before I get to that, I want to just touch about something is that, in fact, I'm going to touch that as my third metric, so I'll leave it. But, a key metric is understanding, how you can create virality so you can grow a lot of customers and minimize your churn. Churn is the drop-off rate, right? But back to EBITDA. EBITDA is a metric that a lot of businesses use, which is basically your earnings before interest, taxes, depreciation, and amortization. It's a very banking, private equity metric. But a lot of traditional institutions look at your EBITDA margin as a benchmark. Now, just to give you some context here, a company as big as Amazon, which is worth $2 trillion, just imagine, $2 trillion.
Unbelievable.
Which is more than the GDP of half of Africa, right? Amazon, for 16 years, had negative EBITDA, i.e. it was loss-making. How is a company worth $2 trillion if you're making a loss? This is the fundamental difference between a startup mentality of exponential growth and an SME mentality, which is a livelihood. Right? Jeff Bezos didn't build Amazon so he could pay for his kids' high school and have a couple of cars and retire at 60. He built Amazon to scale. Right? So that's why if your focus is EBITDA and profitability, you're in the wrong industry if you're a startup, right? So when I say the rule of 40 is, as a VC investor, EBITDA margins are entirely irrelevant, but you can't have negative EBITDA forever. At some point, you have to make a profit.
Yes.
But that time scale could be 10 years, it could be 20 years like Amazon, or it could be 5 years, right? What's important is to say, how do I balance my EBITDA margin, which is a once-off, versus how that EBITDA is growing? So for example, if I am a startup and my EBITDA margin is, let's say, minus 20%.
For argument's sake,
Yeah? But I'm growing my margins are improving every year by 40%. So my minus 10% is growing by 40% every year. So eventually I'm on a track to get to break even.
Yes.
So what VCs look at, and when I say VCs, I mean the good VCs.
Yes.
And there aren't that many good VCs, sadly.
There's some who are just looking to park money somewhere.
No, yeah. Most VCs in Africa sadly look at things like your profitability, your break even, your DCFs, cash flow, all that.
That's an old way of looking.
It's an old way of looking at it. VCs for people as venture capital. Sorry.
Yes.
In the US are usually run by ex-founders or people that have run accelerators that understand founders and scaling and are not, with no disrespect to CAs and accountants, it's a different industry altogether, right? So what they look at is, even if your EBITDA margin is negative, how does it grow? So if today you have a minus 10% EBITDA margin, but you're growing at 20% or 30%, they take the minus 10 and they add the 20. And if that total is 40 or more, I'm okay with it. So if you're Amazon, as an example, 5 years ago, and you had a minus 20% EBITDA margin, but that margin was growing at 50% every year. So your minus 20% now becomes minus 10%. Minus 10 becomes 0. You take minus 20 and you take 50. 50 minus 27 is 30%. So it's 30. So that makes it worth.
Am I right in thinking that you have to really be long-term focused?
Of course.
In terms of even up to 10 years?
Yeah, I mean, venture capital is not a 1 year, 2 year game. It's a 7 to 10 year period. But remember, and I'll get back to my fund in a second, but technology startups raise multiple rounds of funding. In VC jargon, they love alphabets, so it's called Series A, Series A plus, B, B plus, C, D, goes all the way to F. In fact, I recently saw a Series K round. It's crazy.
Really?
Yeah, I mean, it's the US.
Yeah.
So what's important is that at every step of the way, it's like a relay race, right?
Yes.
I mentioned earlier about angels. Angels add a certain value, and then after a certain number of, not months or years, it's about after you achieve certain traction, you move beyond them. You raise money from an early stage VC, like a Launch Africa, for example. And then after 3 or 4 years, our value is diminished.
In the interest of time, let me push you to rule of 4. And then I don't want to forget to talk about Launch Africa as well.
The rule of 4 is very simple. It's basically saying, in startups, you look at growth in customers, so users, and you want to be as viral as possible. So you need to be able to acquire customers, to activate them, to retain them, to refer them to other users, and then eventually monetize them, right? So your growth in users is super important. But at the same time, we don't live in a fool's paradise. So there's always going to be churn. Churn is basically your customers that drop off. So if you can keep your growth to churn ratio at 4 or more, that's a good place. 4 or more. So that ratio. So for example, I'm growing at 50% every month. It's very ambitious. But let's say I'm growing at 30% a month. But 5% of my users are dropping off every month. So 30 divided by 5 is 6. That's good. But I could be growing at 20% every month, and I'm very happy. I tell the whole world, hey, I had 100 customers this month, and now I have 120. But you forgot to tell them that out of the 100 that signed up, 40% of them dropped off. They got tired of your product. So your growth to churn ratio is an important metric. And if that's usually 4 or more,
you're winning.
And these are metrics that you will never learn in business school.
No, not in Harvard, not anywhere.
When you do your MBA at Harvard or an MBA at University of Botswana, they'll teach you what? Porter's 5 forces, which is in the 1980s. They'll teach you things like SWOT analysis. That doesn't what are
work.
my strengths, my weakness, my opportunities, and my threats? It's completely irrelevant in the VC.
19th century.
Well, that's the thing. But unfortunately, this stuff is still taught at business schools. So the stuff that I've covered here is very, people call it new age thinking, but it's not new age. You're just moving with the times. So,
All right. Now let's talk about your fund. It's called what? The Africa Growth Fund?
Launch Africa.
Launch Africa Growth Fund. How does it work, and how can a viewer or a listener be part of it?
Yeah, I mean, so like I mentioned, if you look at the US VC industry, it goes into the trillions of dollars from a size perspective. So unfortunately in Africa, although the VC industry has grown exponentially, I mentioned we went from 20 million to $2 billion in about 8 years. Most of that capital, Mr. Mogobe, goes into later stage businesses, so Series A and beyond. So Series A typically means you're raising about $5 million or more. Series B means you're raising $10 to $20 million and beyond. So it's mature companies that have already achieved significant traction. They're doing about $3 to $5 million at the absolute minimum in annual revenue, absolute minimum.
Yeah.
So it's relatively, I wouldn't say risk-free, but it's a lot of the risk is taken out.
Through this, how do you take out the risk? Through this training and
Through
accelerator
corporate
process.
partnerships,
Yeah.
through traction, through actual revenue.
Like you explained. So
And
it's been de-risked.
It's been de-risked, but a lot of funds only invest in, within the VC community, there is a degree of risk, so the safer investment. So if you have 100,000 customers as a digital bank, you're a safe investment. I'm going to give you some money to grow and scale. So you still have attributes of a high growth, high scaling tech company, but you start from a higher base. So in Africa, in the last 7 years, which is where VC has taken off, once you get to Series A, which is your first institutional round, it is very hard, unless you really screw up, to go down. Because you have 250 plus VC funds all over the world that believe in the potential of growing. Because the African continent, like I mentioned earlier, is ripe for disruption. It's the last remaining frontier for growth. The problem is, before Series A, when you're a startup and you're struggling to raise money from friends, family, and angels like yourself, the drop-off rate is very high. And this is a very important point for our listeners here. It's not because you are a bad founder or you have poor technology or you have no product market fit. It's just, if you want to scale businesses, you need a certain basic amount of capital. And that capital does not exist in Africa right now. It's mostly friends and family and people like yourself and the angel network of Botswana. How can that be scaled is $1 million question. In the US, sorry, there are plenty of funds that fund businesses at the seed stage. In Africa, that gap is a big gap. So if a startup does not have product market fit or a problem solution fit, I have no problem with them going under. They deserve it, because in a non-judgmental way.
It's a very hard way of putting it.
It's a hard way of putting it, because you didn't do enough market research. You didn't spend time understanding your customers. You didn't do enough diligence. You don't deserve to succeed. I'm sorry.
Maybe harsh, but
it's a bit harsh, but it's true. We need to hear this. But if you have achieved product market fit, you have a product that customers want, you have happy customers, your tech works, you have the right marketing team, but you don't have money to cover your burn. Your burn is what you use.
Burn rate.
Your burn rate. It's just unfortunate that that there isn't capital to cover a fast-growing company. And there's nothing worse than a startup dying because of a lack of capital, which has nothing to do with how good its business is.
So do you see that capital and that thing as you supply the rocket fuel, really, for the company to launch?
You're providing rocket fuel for them to acquire more customers, get to about $100,000 to $200,000 in recurring revenue every month, and then the bigger VCs come in. And that's what Launch Africa does. It's the only fund, as far as I'm aware, that covers the entire African continent, that provides rocket fuel to entrepreneurs that have gone through accelerators, that have gone through seed programs, that understand things like growth hacking, moving my IP offshore, understanding exponential scaling of legal, HR, tech, etc. So you've done all your basic homework, and I'm helping you scale to get to Series A. And that is a big missing piece that we provide. So we provide capital of up to $250,000, which is a lot of money in Pula or
$250,000. That's probably what, 2.5 million Pula?
Plus minus. But also beyond that, the investors in our fund are allowed to invest directly into these companies. So most seed rounds in Africa, are usually around the $1 million mark. And what's crazy, Mr. Mogobe, is startups will spend 2 to 3 years, if not longer, raising $1 million. Why?
True.
Because the average angel gives you a $10,000 check, maybe $20,000 check. So as a founder and a CEO, when you should be every day on the phones or meeting people to acquire customers, what are you doing? You're on the phone with angels like yourselves. Hey, I have this incredible product. I've got customers, product market fit. We're making our unit economics are good. I need $1 million. And someone says, I'll give you 10,000. And then you're doing that for 3 years. And as a founder and your team, you're spending half your time fundraising.
How do you respond to those founders who tend to be very territorial? Say, I don't want to be diluted. I don't want to lose my thing.
It's a big problem in Africa. It's because you have small mind thinking.
Yeah, but how do you get over that? How do
you just give them examples. I mean, there's nothing better than showing examples of founders that have crashed and burned because they want to own 90% of a business that's worth this, maybe $1 million pula, $2 million pula, versus smart founders that say, I'm a founder, I know product, I know tech, I know a bit of marketing, but I'm humble enough, to my point earlier about assertive founders versus arrogant founders, to say, there are things that I know, and there's a lot that I don't know. So if I bring in a VC, if I bring in a large corporate, I bring in a partner to share in my wealth, but they help me grow to places I could never grow. If I'm a founder and I say, I have 100 customers right now, I want to get to 1 million customers in 2 years, it is impossible to do it by yourself. But what do? I talk to a VC, a prominent angel investor. I talk to a large corporate and says, hey guys, I'm going to dilute myself down, but I would rather have a slightly smaller stake in a much larger pie than be the king of my castle, but my castle has nothing in it.
Yeah, my castle is
and if you look at the smartest founders in Silicon Valley, in India, in Israel, in Europe, they understand that very early on. If you go and look at the majority of African founders until about 2 years ago, and look at the cap tables after 5 years, the founders still own 80%. And what are you worth? $1 million pula. How am I as a VC going to put money into your company? And that brings you to another point. I'll sort of taper off here. Is that it's a relay race.
Yes.
You need to incentivize the incoming investor that there's enough of an upside for them to come in. Now, at the other extreme are the really evil VCs. They're usually the most inexperienced, and they will come in and say, at your seed round, at your Series A, I want a 40% stake in your company or a 50% stake in your company. And because there's such a shortage of capital, founders will agree to those terms. Now, if a founder isn't running a startup for a salary, founders do it for the upside, the exit, as they call it. Right? So as a founder, the benchmark is post your Series A, which is your first institutional round, if you don't own at least 50% of a company, of your own company, why is it a bad signal? Because as an incoming investor, as VCs, we only make money if the founders are incentivized to make money. If the founder has diluted so much of his or her stake that by your Series A round, you own 10% of the company, because greedy VCs have taken your entire cap table out, what is your incentive to become the biggest e-commerce company, the biggest fintech?
Time is a bit of our enemy here. We've covered such a wide ground. Can I invite you to put the question to me before we close? What question do you want to ask?
I have so many questions for you, but I'm going to limit it. If you're saying one question, I would say, what do you think needs to be done in Botswana? Because I know that there's a lot of capital in Botswana, but it's unfortunately going to more traditional asset classes. And people are very happy with subpar returns. So someone in Gaborone or anywhere in Botswana is happy with a 20% return year on year.
People still
and people don't realize that the wealthiest people in the US are people that are 25, 30 years old that have understood how to invest in exponential technologies, where 20% per year is a disgrace. It's a disgrace. The wealthiest people in Silicon Valley make about 200% a year because they understand risk-return trade-off. So how do you think we can change the mindsets of people? Because it's not about how much you have, it's about how you think. How do you think we can change that?
I come from a real estate background.
Yep.
Where people get excited over returns of 12%, 15%, which is more than embarrassing.
Which minus inflation is about 7%.
Yeah, if you consider it. And the current interest rate environment is terrible.
Yeah.
So it's going to require a huge paradigm shift.
Yeah.
The beautiful thing about having people like you, people who have already seen it, people who already understand you, is that we're able to, to provide, if you like, proof of concept in terms of showing how it's done. I think there is a realization that from government, when you look at things like Botswana Innovation Hub, of which you're a part, there's a realization that we need to shift. But enough is not being done. I think the way what we're doing at A&B, Angel Network Botswana, is to invite persons like you. We have a guy called, another guy called, what's his name? You say you know him? Who's coming to make
Abu Kasim from Josie
Yeah.
Angels. Yeah.
So we're now making a conscious, deliberate effort as Angel Network Botswana to help government to bring in people like you to actually, even through platforms like this show, to showcase and to say, look, guys, we're lagging behind. There's no reason why Africa should be behind. Even if you look at FDI, I mean, in terms of what's happening in other continents, Africa is always the last. So I don't think there's any magic pill out there other than to continually harp
what's also important is that angels love to see results.
Yes.
So if you go and say, hey, a bunch of South African angels, a bunch of Nigerian angels made 10 times your money on these startups in 3 years. Are you happy with your 2 times in 5 years? So there's a certain amount of FOMO, for lack of a better word, but it's also, there's no point in people delivering a 3-hour lecture on angel investing versus a 5-minute say, this is what actually happened. For Africa, so enough of the Uber, Airbnb, Twitter, Dropbox examples. Let's show them examples of how angels made shitloads of money, excuse my French, investing in African tech startups in the last 5 years. And the question is, hey, do you want to be part of it or not? And
simple.
We're asking you to take 5%, 10% of your net wealth, invest it into startups, and put it into funds that can invest in 50, 60, 100 companies.
I think the message is getting through, and I think that a lot of people. You've been in Botswana now a week or two.
A week now.
And how's the response been?
It's positive. I mean, I think
there's an indication
it's changing slowly.
Yeah.
Remember that South Africa was at this stage about 5 years ago. Nigeria was at this stage 7 years ago. I can tell you now, Nigerian angels who would never have touched a startup with a 10-foot pole are now queuing up to invest. Why? Because there are very successful Nigerian tech startups that are worth 50, 100 times what they were worth before. And they see, gosh, I can't miss out on that. So Botswana's time will come. But Botswana angels should start looking at, let me look at Pan-African first, and then eventually that filters down into Botswana.
Zach,
I mean, we spoke about Alpha Direct
time
earlier.
is not on our side.
Yeah, sure.
Look at that camera and talk to a potential investor, talk to a potential entrepreneur.
I hate doing pitches, but yes.
Sure. and just give them a short 1-second pitch and tell them what you're about and give them some inspirational message, as a takeaway, so to speak.
Yeah, I mean, so Launch Africa Ventures is the largest seed fund in Africa where we invest into disruptive early stage technology startups all across Africa. We invest capital where typically only friends and family and small angel investors come in. So we are the first institutional check into a startup that is already post-revenue and has traction, but we help them scale to get to a Series A and Series B round of funding within 3 to 5 years. We get in at valuations that are very attractive. I'd almost call it an arbitrage because there is a gap in the market. And we look at making, at a bare minimum, 5 to 10 times our money within 3 years per startup, but split across a fund of 50 companies. We are literally the largest early stage VC fund in Africa. And as an angel, if you want to take some of your assets and put it into an innovative high technology asset class, Launch Africa Ventures is a good place to start and get your feet wet, and then go more deeper into companies directly later on.
All right. How do people get hold of you? Are you reachable on social media or by email?
Yeah.
Go ahead.
I'm on Twitter, Facebook, LinkedIn, etc. My name is Zachariah George, ZACHARIAH space George, GEORGE. The fund is called launchafrica.vc, LAUNCHAFRICA.vc. My email is Zach, ZACH, at launchafrica.vc. Would welcome any interesting ideas. So if you're an angel investor that wants to look at investing into African tech startups, or if you're a founder that has an innovative business model that is post-revenue. So if you're doing at least 500,000 pula in monthly recurring revenue, come talk to us. Okay. Nothing against founders that are doing less than that, but that's our sweet spot. So yeah, thank you for the opportunity.
Well, let me take this time to thank you, Zach. You've been on fire. You've been a wonderful guest. Thank you so much.
Thank you.
I really look forward to having you again when you're next in Botswana.
Sure.
So that we can progress this conversation. Thank you so much.
Thank you. Appreciate it.